When it comes to trading futures, some of the most significant market movements happen around the Federal Open Market Committee, or FOMC, rate decisions. These meetings set the tone for U.S. monetary policy, and the decisions made in these meetings can ripple through the markets. Let's explore why these events are so crucial for traders and staying up to date with them is so important. And today we're discussing the importance of the FOMC, from what it is, why it matters, and how its decisions can influence futures markets. If you're trading futures, you'll want to pay attention to these meetings. So what is the FOMC and why is it important? The Federal Open Market Committee, or FOMC, is the policy-making body within the Federal Reserve, which is the central banking system of the United States. The FOMC consists of 12 members, including 7 members of the Board of Governors and 5 regional Federal Reserve Bank presidents. They meet 8 times per year to review economic conditions and set United States monetary policy, specifically interest rates. Why is this important? Because the FOMC's decisions directly have an impact on short-term interest rates, long-term interest rates, inflation, and economic output. These meetings are highly anticipated events for traders because they may shift the market, and any shift in the Fed funds rate can ripple across multiple markets, creating both opportunities and risks. So, how does an FOMC rate decision impact futures traders? The FOMC's decisions can trigger significant market reactions, particularly in futures markets. For example, when the FOMC lowers interest rates, it can stimulate economic growth, which can send the stock index futures like the E-mini S&P 500 higher. Conversely, if the FOMC raises rates to combat inflation, stock index futures might drop as traders anticipate slower economic growth. The rapidness with which these changes can occur in the market largely actually depends on the language the Fed uses in their reports rather than the decision itself, and if there's any unexpected decisions. So what should you watch for during FOMC meetings? FOMC decisions are more than just rate announcements. Traders also closely watch the Fed's post-meeting press releases and the report language that's released upon the decision. The press releases are where the Fed discusses the state of the economy and offered forward-looking insights. These statements can be more important than the rate decision itself, as the language used provides further context about future policy moves. What should you do when trading around FOMC decisions? As mentioned, these decisions tend to create volatility in the markets, both before and after the official announcements. Traders often prepare for potential market moves by analyzing economic indicators, gauging market sentiment, and reviewing the Fed's prior statements. After the meeting, markets react quickly to any surprises, especially if the Fed's decision is unexpected. For futures trading, timing is crucial. Some traders may avoid trading during these events entirely and potentially only trade afterwards, while others look to capitalize on price swings. In short, decisions on interest rates and monetary policy can be major market-moving events that every futures trader should follow closely. Understanding the FOMC's impact on futures can help you navigate volatility and identify potential trading opportunities. Thanks for watching. If you have any questions about how FOMC meetings impact futures trading or anything related to futures, reach out to the link in the description. We'll see you next time, and happy trading.